This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Okay, now we meet, as we mentioned at the end of the previous session, the various accounting schemes that have been created by HMRC specifically to assist small businesses. Now, there are 3 of these that exist within our syllabus at F6. And I put 2 of them, the big 2, together into one note, one section here. The reason being that for both cash accounting and annual accounting schemes, the rules for eligibility to operate such schemes are the same, so far as these so-called small businesses are concerned. The way that we're going to deal with them is by means of illustration, which will bring out the points relevant to the operation of these schemes. But if I just show you the key issues in terms of eligibility here, in terms of the 2 illustrations, dealing with firstly cash accounting and then with annual accounting. What we're told here in section 1, this company will be able to operate the cash accounting scheme provided its expected taxable turnover for the next 12 months does not exceed 1.35 million. And point 6, it will be able to stay in the scheme until annual taxable turnover reaches 1.6 million. So there is your basic eligibility, firstly to join and then to remain within the cash accounting scheme. And so it is also, when we look at illustration 6, that we have the same eligibility rules when it comes to the annual accounting scheme. Here in this illustration, the company Crocus Limited can apply to use the annual accounting scheme, provided that its expected taxable turnover for the next 12 months does not exceed 1.35 million. Exactly the same as we had with cash accounting. And, as well as that first point being a constant, the last point here, the business can stay in the scheme until annual taxable turnover reaches 1.6 million. So there we've got common facts that relate to each of these 2 schemes. Now, these were designed by HMRC to help specifically small businesses. We now see how we've defined small, and with that level of taxable turnover, we're actually talking about quite a lot of businesses. There will be many hundreds of thousands of businesses indeed that operate at much lower levels of activity than these, and that therefore would be eligible so far as these schemes are concerned. But HMRC recognised that specifically small businesses were, before the schemes came into being, getting into trouble with the penalty system. Maybe in terms of late submission of VAT returns, and just the penalty system would then apply, but also getting into cash flow difficulties given how it was we accounted for the VAT in relation to our sales and purchases. So let's look at how these 2 schemes work and how they're designed to help businesses. Right. Firstly, the cash accounting scheme enables a trader to account for VAT, output VAT, on a cash basis. Now, normally, of course, we allocate a transaction, a sale, an output, to a VAT return period, normally a quarter, but as we've seen, it could be monthly, or now we will see annual. But we allocate a sale to a VAT return period based on the tax point. And the tax point, more often than not, is going to be the invoice date. So what a small business may do is to invoice for a lot of its sales just before the end of a VAT return period. Now, you already know when in relation to that VAT return period, the business must then pay the VAT. We have, as we know, to submit that VAT return and to pay the VAT thereon 1 month and 7 days from the end of that VAT return period. Now, if we are dealing with a small business and maybe their key customers are large businesses, then right or wrong, I think it's going to sound pretty wrong, what those larger businesses may do is to take advantage of their importance to that small business as a customer, and therefore they delay making the payments to that small business. Now this can therefore lead to huge cash flow problems so far as the small business is concerned. Because think what it's had to do to make the sale. It's had to buy and pay for raw materials that it has purchased. It has incurred expenses in terms of electricity, gas bills, whatever, energy costs that it's had to pay for within the period. And it's had to pay wages to the employees, to the staff that work within that organisation. All of that is cash flowing out of the business. And at the end of that, then the final reward, we make a sale. And those sales then are recorded in terms of our VAT return just at the end of the VAT return period. And what then happens as a result of making the sale in cash terms? We then have to pay out yet more cash. The 20% VAT on the sale that we have made, we have to account for the output VAT 1 month and 7 days after the end of that VAT return period. But it may be 2 months, it may be 3 or more months before the cash comes in. So what reward have we had for the sale? Paying more money out. Now that again can quickly lead to serious cash flow problems. And that can be the undoing of a business, especially a small business that maybe has not got much in the way of cash resources to be able to deal with this problem. If it can't pay the wages to its workers, we've got a real problem here. So HMRC rightly brought in the cash accounting scheme. So what does it mean? It means that here in point 3 of this note, the scheme will result in the company's tax point becoming the date that payment is received from customers. So now, rather than allocating that sale to basically and mostly, usually the VAT return period in which the invoice was issued, the sale was made, not any longer. We will only have to account for the output VAT when the cash comes in. So that means, therefore, we're not going to be out of pocket in the intervening time period. It also means something else that will be of advantage to us, and that is that effectively we'll get automatic bad debt relief in relation to VAT. Because if that debt proves to be bad and the cash never comes in, then we'll never part with the output tax on the sale, something that would otherwise have happened had we gone to the normal system that usually, of course, meant that the invoice date became the tax point. So, this scheme will delay the payment of output tax and also provide for automatic bad debt relief should a customer not pay. Because if the cash never comes in, the output tax will never be paid out. And as we've said, the major reason in terms of slow paying customers, hopefully that's our only problem rather than those that don't pay at all, but with slow paying customers, at least now we won't have to part with the output VAT, 20% of that sales value to us before we have received the cash. Other issues here, to be able to be eligible, the company must be up to date with its VAT returns and VAT payments. That is also a situation for the annual accounting, must be up to date with its VAT returns and payments. That is, if it's other than a new business. New businesses, again, if they're estimating the taxable turnover at less than 1.35 million, will be eligible for the annual accounting scheme, as well as the cash accounting scheme here. So we've got certain points that are consistent between the two. But again, in terms of cash accounting, what is it doing? It means that we do not have to account for output VAT until the cash comes in from the sale. We're told here in terms of this particular example that Violet Limited gives its customers a 30-day credit period but pays for most of expenses in cash, so it is not permitted any credit period from its suppliers. Violet wants to know what conditions must be satisfied before it will be permitted to use the cash accounting scheme, and the implications then of using that scheme. Now again, final point mentioned here, since Violet Limited pays in cash for its expenses, the company's recovery of input VAT will not be affected. Again, in terms of what this scheme does, the scheme will normally be beneficial. Oops, let's try and get a better straight line than that. The scheme will normally be beneficial where an extended period of credit is taken by customers. It also results in, let's hope it's not a particular problem in terms of our sales, but automatic bad debt relief. The disadvantage is that input VAT will only be recovered in relation to when payments are made. So in terms of Violet Limited here, this point, we were told that we pay for most of our expenses in cash. So in which case, since Violet Limited pays in cash for its expenses, the company's recovery of the input VAT will not be affected. But before opting for this cash accounting scheme, yes, you've not just got to think about the time taken by your customers to when they pay you, but of course also the credit period that you take from your suppliers there, in terms of whether or not the scheme will be a good idea. Okay, so you need to know how the scheme works, who is eligible, and the advantages and disadvantages of the cash accounting scheme. Onwards to the annual accounting scheme, where we've already seen who is eligible and the conditions that must be applicable for it. What is it? Well, it's a bit of a self-explanatory statement in many ways. Annual accounting scheme. What are the advantages? Well, mainly administrative, of course, since a trader only has to make one VAT return each year. However, you don't just pay your VAT once a year. Payments on account of the annual VAT liability will normally be required, and these will usually be on a monthly basis. And what that will mean is it should make budgeting for the payment of your VAT a lot easier in terms of preparing a cash budget. Again, no doubt you remember cash budgets from your management accounting studies that you've already done here. All right. We know that otherwise, in terms of VAT, you'll have quarterly returns and you will have to pay out the VAT 1 month and 7 days after the end of the VAT return period. This way, on monthly payments, you will be able to determine ahead of the accounting period how much will be paid out in VAT through the accounting period. We would normally be able to bring the VAT year into line with our accounting period, and we could therefore budget for regular monthly payments. Now, when and how many of those monthly payments are made, we'll see in a moment in terms of illustration 6. But it will make cash flow budgeting a whole lot easier in terms of the majority of the year. Let's see how that works in terms of our illustration 6 here. The company, Crocus Limited, wants to know the advantages of the annual accounting scheme and when it will be permitted to join. The company's annual turnover is £450,000. There, of course, was a critical factor, as we have already noted and stated in point 1, that is that the expected taxable turnover for the next 12 months should not exceed 1.35 million. If we have already been trading and we're not opting for the annual accounting scheme from the start of what is a new business, then we do indeed, of course, have to be up to date with our VAT returns and our VAT payments. The scheme is pretty obvious, as we've said here in point 3. Under the scheme, only one VAT return is submitted each year. When will it have to be submitted? It will be due within 2 months of the end of the VAT year. Now that again is usually synonymous with your accounting period, but it must be submitted, this VAT return, and any, as we'll call it, balancing payment of VAT needs to be made within 2 months of the end of that year. When do we pay? Usually monthly. It's possible to do it quarterly, but for our syllabus we'll be looking at this one. 9 monthly payments are made on account, each being 10% of the previous year's VAT, or of course if we're a new business, our estimate of the VAT for the next 12 months. Each being 10% of the previous year's VAT, and those payments are made in months 4 to 12. Now you may be thinking, hang on a minute, each being 10%, 9 times 10 is only 90%. Why 90%? The reason being, you make those payments on account through those 9 months, from month 4 to month 12 of the period. With any balancing payment, here's the 10th and final payment, any balancing payment being made with the VAT return. As we said, you can work on a quarterly basis instead, but again it would routinely be a monthly basis so far as we are concerned. Okay, now we can see there the benefits so far as the company is concerned. We don't have to submit quarterly VAT returns, so we lose some of the administrative burden of operating the VAT system that we're required to do. We've got 2 months from the end of the accounting period to amass all of the information and to submit that VAT return. And in between times, through month 4 to month 12 of that period, we have known what those regular payments on account will be. So in terms of your cash budget, your cash flow budget there, you know what payments will be made. The only thing we don't know, of course, is what that balancing payment will then have to be 2 months after the end of the accounting period. Okay, take time then, take a moment to read through and review through the information provided there. Again, they are a commonly tested issue so far as your exam is concerned, and we're expected to know what are the rules of eligibility for when you may join or when you may leave, and of course also then the reasons as to why you might want to join into those particular schemes and any benefits or any disadvantages that attach to them. The last of the 3 accounting schemes that we need to be familiar with in terms of our F6 syllabus that is available to small businesses is the flat rate scheme. And the first thing that we'll pick up on here is we're talking about a much smaller business entity. If we just look at note B here in this section, the scheme can be used if the expected taxable turnover for the next 12 months, the expected taxable turnover, so taxable turnover is the combination of taxable supplies, which is of course both standard and zero rated. If our expected taxable turnover for the next 12 months does not exceed £150,000. That £150,000 being exclusive of VAT. Exclusive of VAT. So if the expected taxable turnover for the next 12 months does not exceed £150,000. You can see the sort of activity levels that we're talking about are way, way smaller than those applicable to either the cash or annual accounting schemes. Again, there then comes a level at which we'd be required to leave the flat rate scheme. The business can stay in the scheme if turnover is not greater than 230,000. Now here we've said turnover rather than taxable turnover. So this time it will be both taxable and exempt supplies. And the figure of 230,000 this time is inclusive of VAT. It is inclusive of VAT. So you'll be expected to learn, and you must learn of course, closer to the examination date, depending on exactly when you are listening to this, about these 2 activity levels. The £150,000, that £150,000 being exclusive of VAT and being taxable turnover, as compared to the 230,000, which is inclusive of VAT and includes both the taxable turnover and any exempt supplies if made. Turnover is determined by the method used to determine the VAT whilst in the scheme, and we're able to have either a cash or invoice basis. Although we can't run the cash accounting scheme, we can do our calculations of the tax to be paid on a cash basis. How does the scheme work? Under the flat rate scheme, a business calculates its VAT liability by simply applying a flat rate percentage given by HMRC based upon the particular trade sector that business is within. So there are set levels, set flat rate, hence its name, flat rate percentages applied. And it makes the VAT calculations incredibly simple, because all we do, as it says here, a business calculates its VAT liability by simply applying this given, and it will be given to you in your exam question, by applying the given flat rate percentage there to total income, inclusive of VAT, and any exempt supplies. So it's both your taxable income, inclusive of VAT, and any exempt supplies. So even though exempt supplies have no VAT on them, you just add these numbers up. And you then apply the flat rate percentage. So this therefore removes the need to calculate and record that output VAT and recoverable input VAT that normally goes through and onto a VAT return. Now this makes life so much easier in terms of accounting for VAT. The usual problems for business is we will of course know our figures of sales and the output tax applicable to those sales, but trying to sort out in many cases what input tax we've suffered on our various purchases and expenses, and how much of that is recoverable and how much of it may be irrecoverable, is what gives real problems, especially to small businesses. So now the VAT calculation for your VAT return period has become a single calculation. Add up your total sales for the return period inclusive of VAT and apply the given percentage to it. How easy is that? The flat rate percentage, as we've just said, is applied to the gross total income figure with no input VAT being recovered. Again, it now is irrelevant. Clearly the flat rate percentage is something less than 20%. Depending on what type of trade sector it's in, that may be again relatively high or relatively low. The percentage, as we've said, varies according to the type of trade that the business happens to be involved in, and as we've said, is given to you in the exam. VAT at the rate of 20% is still treated as being charged where a supply is made to another VAT registered business. If you have as a customer another VAT registered business, then your sale to them becomes their purchase and they would seek to recover the input VAT. So they need to have, again, a suitable VAT invoice that must be issued to them, forming the basis upon which they can then recover the input VAT. But this offers the possibility of much quicker and easier VAT returns to be submitted. It demands for you, the business, to calculate just one figure. That is, what was the total sales made during that return period, where applicable, inclusive of VAT. We do not have to maintain separate records of the output tax on our sales, and very specifically of what is recoverable input tax in relation to our purchases and expenses. Now, whether, of course, it is a good idea to join it will be based on comparing how much VAT the business would have to pay using your normal quarterly VAT return system and normal system for accounting for VAT with how much you'd be paying under the flat rate scheme. So we've got our little example here, illustration 7, part A, Snowdrop. Annual sales of £120,000, all of which are standard rated and our customers the general public. The company's standard rated expenses are £6,000 per annum. These figures are inclusive of VAT here. These figures are inclusive of VAT. The relevant flat rate percentage for Snowdrop Limited's trade is 15%. So, if we were to use the normal basis of calculating the VAT liability, Snowdrop Limited will have to pay the VAT as follows. Now, this would be based on an annual outcome. Our output VAT, our annual sales, £120,000. That figure we were told inclusive of VAT. Output VAT, 120,000 times 20 over 120, £20,000. Input VAT, again based on a VAT inclusive figure of £6,000 per annum in relation to our expenses, 21/20ths of 6,000, £1,000. So the overall amount of VAT payable, 19,000, would be what would be being paid on the normal system. If Snowdrop uses the flat rate scheme, then it will pay VAT of 18,000. How do we get that? Pick up the VAT inclusive figure of sales, 120,000, and apply the given flat rate percentage for your particular business's trade sector. That there is 15%. 120,000 at 15% is £18,000. So under the flat rate scheme we pay 18, under the normal accounting scheme we pay 19, so there's a VAT saving of £1,000. In addition, of course, to the simplified administration. Again, calculating VAT each return period now is very simple, just 15% of the VAT inclusive figure of sales for the period. None of Snowdrop Limited customers are VAT registered, they're just members of the public, so there'll be no need to issue VAT invoices. A rather more simplified, simple invoice may be issued there. So again, another administrative saving. Second and final example now in relation to our flat rate scheme. This time Primrose Limited has annual sales of £96,000, of which 50% are standard rated, 50% are zero rated. All of the company's sales are to VAT registered businesses. The company's standard rated expenses are £30,000 per annum, and again these figures are inclusive of VAT, so we're going to take 21/20ths in terms of establishing the relevant amount of output and input tax. Our relevant flat rate percentage provided to us is 6%. Using the normal basis of calculating its VAT liability, Primrose Limited will have to pay VAT as follows. Right, what was our level of sales? 96,000 inclusive of VAT, 50% standard rated there, 50% were zero rated. So 50% of those sales of £96,000 will have had output VAT accounted for in that sales revenue figure. So it's a VAT inclusive figure, so we take 21/20ths. So 96,000 times 50% times 21/20ths, there is your output VAT. Input VAT. Now, all of the input VAT may be recovered because all of it is in relation to taxable supplies. The fact that some of those taxable supplies are standard rated and some of them are zero rated does not matter. We will be able to recover all of the input VAT on all of the expenses as they all relate there to taxable supplies. Input VAT, 30,000 times 20 over 120, £5,000. VAT payable, 3,000. So that is what your normal calculation would be. What now happens under the flat rate scheme? Then it will pay VAT, well there the end result, £5,760, being the VAT inclusive figure of sales where applicable, £96,000 times the given flat rate percentage, 6%. Now very clearly therefore we can see that this is significantly greater than what your normal VAT payment would be. So as the note says, although the flat rate scheme will result in simplified administration, again it's a very easy calculation of VAT, it's not beneficial because we're going to pay additional VAT of 2,760. We're going to be paying 5,760 instead of 3,000. This is not worthwhile. Also, of course, Primrose Limited would still have to issue VAT invoices, whether we do or whether we don't adopt the flat rate scheme, because the customers are registered for VAT. So in part B of that illustration, we do not want the flat rate scheme. In the first part, we do. Okay, now those then are the accounting schemes, and one or other of those comes up on a regular basis. So again, a most definite need to know the conditions relevant for eligibility for each of those schemes in terms of our so-called small businesses, how the systems then work, and the advantages, where there are, and the disadvantages, where there are any, of operating those schemes. Okay, again, take a moment just to work back through those examples, if you would please, before then we move on to look at the remaining final two areas of VAT within our syllabus. Okay, just two more important areas of VAT for us to study, for us to conclude our VAT studies for this paper. First of these two areas, group VAT registration. Now this goes back to what might seem like a long time ago now, but was our chapter on groups in corporate tax. In fact, just a few chapters ago. Group VAT registration. Who is eligible? Which companies are eligible for group VAT registration? Well, of course, we had the bare minimum level of share ownership here for group VAT registration to apply, a mere 51%, I should say, more than 50%. Two or more companies can register as a group for VAT purposes. They must be under common control of a third company and be resident in the UK. So as long as within the group you have at least 51% direct ownership there, then those companies will be eligible to join into a group VAT registration. Now notice I've said there they will be eligible for a group VAT registration. This is not compulsory. Therefore, the interesting part of this study area is that maybe you may have to give advice to a company, a group of companies, as to which of their group companies may be advised to remain out of a group VAT registration and which companies to include within the group VAT registration. But before we can do that, let's have a little look at what it means. The implications. The group will be treated for VAT purposes as if it were a single company registered for VAT on its own. Now clearly there has to be now a group VAT return that is submitted, and it's submitted by the so-called representative member of the group. Now again, the group can appoint whichever of the group companies. It doesn't have to be the parent company here. Indeed, the parent company doesn't necessarily even have to be within the group VAT registration because of this choice element that exists. But we will choose a representative member of the group, and it's that company that is responsible for completing and submitting what is then a single VAT return for the members of the group within the group VAT registration, and paying then the VAT on behalf of those group members. Now, although it is the one company, the so-called representative member, that administers the system and submits the VAT return, all companies in the VAT group are jointly and severally liable for any VAT liabilities of the group. Yeah, you can't therefore put all your companies in your group into a group VAT registration, pick a small one in terms of being the representative member, build up huge VAT debts within that particular company, and then bankrupt it and liquidate it, say, oh, sorry, got no money. HMRC can simply, therefore, turn our attention to the other members of the group VAT registration and go chase any and all of those for any amounts due. What are the advantages of having a group VAT registration? Yes, it's available to these group members, but why would they choose to do it? Well, to begin with, as we've already said, there is just one VAT return to be submitted. So that second point there, only one VAT return to be submitted for the group as a whole, so you'd expect therefore some administrative advantage. Although, as we'll see when we come to the disadvantages, although it's only one VAT return to be submitted, you've still got to collect, of course, in that representative member, all of the figures still from each of the group companies within the group VAT registration. If any one of them is late or is incorrect, then you're going to have problems for the VAT return. So you've still got to amass the same information. No VAT, however, is accounted for on the transactions between group members within that VAT group. Yes, on any intra-group transactions, there'll be no VAT to charge. You're not going to charge VAT, as it were, on yourself there. It's just like you are moving. Again, it could be, in terms of transactions, it could be the transfer of a material, a commodity, a part, a component, a service. But no VAT would now be charged. There'd be no output tax for the vendor to account for, and there'd be no input tax for the buyer to seek to reclaim. No VAT on intra-group transactions. And we said the group can choose which companies to include or exclude. Now then, this is the interesting bit. Why is it that we might therefore choose to leave some companies out of the group VAT registration? Because it would seem possibly like quite a good idea to only have one instead of several VAT returns to submit, and to avoid having to account for output VAT on intra-group transactions. Well, where it would be beneficial to exclude, it would be beneficial to exclude a company making zero-rated sales, as it would then be able to continue making monthly returns. Now think, if a company in the group makes zero-rated sales but has standard rated inputs, why would we want to, and presumably would, prepare VAT returns on a monthly rather than a quarterly basis? Why? Because it will get VAT repayments. So we would have monthly returns to get the improved cash flow of monthly VAT repayments. Now we could maintain that by submitting individual monthly returns for that company and getting the repayments of VAT, while putting the other members of the group, or as many of them as we choose, into the group VAT registration, and then submit those group VAT returns on a quarterly basis. So we pay them on a quarterly basis, they pay us, in terms of the company making zero-rated sales, on a monthly basis. Therefore, cash flow, it's a good idea. Now, although we do not have to deal with much in the way of companies making exempt supplies, and the term partial exemption does not mean anything to us in terms of our studies, but another statement you could make here as regards an issue as to why you might leave a company out of the group VAT registration is that if it were to be one making exempt supplies, one of our group companies made exempt supplies, then if it joined into the group VAT registration, then that would make the group as a whole, the expression we use, partially exempt. Now that would not be an expected answer, because partial exemption is not within your syllabus, but it would certainly be a valid answer if you were asked to think in terms of reasons why you might choose to leave one of your group companies out of a group VAT registration. If a company makes exempt supplies, bringing it into the group makes the group as a whole partially exempt. That will impact on the group's ability to recover its input tax. Disadvantages? Well, limits for cash and annual accounting schemes that we've just been talking about will apply to the group as a whole rather than to the individual companies, and that therefore may make it less likely that we would be able to use, in terms of any of those businesses, either the cash or annual accounting schemes. Other points, as we've said, that we've already made the point, joint and several liability for each company in the group for the group's VAT debts. And still got admin issues with collecting the information to be passed through to the representative member. We still have the same problems, that the information about each particular company's inputs and outputs need to be determined. Okay, again, take a moment please to go back over and rethink through the points that we have just made in terms of group VAT registration. But in terms of a written question, a section C question, there are constructed response questions, that sort of exercise, giving advice over how a group VAT registration system works and which company or companies we may choose to leave out or otherwise to put into the group VAT registration is probably worth about 4 or 5 marks. So again, important marks. Check through, make sure you're happy with it. Before then, we'll come to what is, you'll be happy to hear, the last of our areas of VAT that we need to know about for our particular exam. Well, this final area, we now have to consider how do we deal with the VAT implications of sales made by UK VAT registered businesses to overseas customers, and how do we deal with acquisitions, purchases made by UK businesses from overseas businesses. What we've got to look at here is the supply of both goods and services. Main rules associated with the supply of goods. Now, as you'll see from the heading here, we'll be dealing and looking at 2 sets of rules. That which applies with UK businesses trading within the EU and then having transactions with businesses outside, or customers or suppliers outside of the EU. At this point at which I speak, we are still hanging on by our fingernails, but at least still within the EU. And that's not going to change for at least probably a couple of years there. We'll see when, of course, the F6 syllabus changes. That will be a few years down the road. But for us, it is that the UK is within the EU, and therefore these rules apply. So as it says at the top, UK businesses do indeed frequently trade with companies or individuals within other EU or non-EU countries. We've got to look at the VAT treatment of what I've loosely called here exports, sales made by UK businesses to overseas customers, and imports, purchases made by UK businesses from overseas suppliers. What we'll see, however, is we've already distinguished between transactions that are within the EU to transactions which are outside the EU. So in relation to the supply of goods, what we have is when we trade with non-EU countries, when we sell to them, we call them exports. When we buy from them, imports. I'm sure words that you are familiar with, imports and exports. When we are trading with other EU countries, then instead of referring to exports when we make sales to customers in those other EU countries, we talk about dispatches. And when we buy in from businesses within the EU, we don't talk about imports, we talk about acquisitions. Now, other than the names, what of course applies in terms of the system. So let's look first of all when we're trading with non-EU countries. So we've got a UK VAT registered business and it has got customers within the USA. These therefore are sales made which are export sales. The supply of all goods is then 0 rated. So whomsoever we are selling to as our customers in the USA, whether they are individuals consuming our goods, whether they are businesses buying our goods, the supply so far as we're concerned is 0 rated. It is of course for us, the UK business, a taxable supply, but one that is at a 0 rate. In terms of if we were trading with EU countries and we made sales to those customers, then the VAT treatment will depend upon who that customer is. Whereas outside of the EU, selling to all of my American customers, whomsoever they may have been, businesses or individuals, it made no difference. The supply of goods was 0 rated. Now, within the EU, when a UK VAT registered business supplies goods to another VAT registered business, so now we are distinguishing our customers between those that are VAT registered businesses within the EU and those that are not. Well, where we sell to another VAT registered business within the EU, the supply is again zero rated. Zero rated. But if the customer does not have a VAT registration, typically of course members of the public here, then the UK supplier will charge UK VAT at the rate in force at the time of supply. So if that sale, if made to a UK customer, would have been a standard rated supply, then we'll charge standard rated UK VAT. So what does this mean? It means that when we sell to anybody, whether a business, an individual, whatever, outside the EU, the sale is zero rated. When we sell to customers within the EU, if it's another VAT registered business, again it is zero rated. If, however, instead of shall we say, selling to Pierre Inc. Incorporated, a company there incorporated in France, maybe a Parisian company, we were to sell to Pierre, an individual who lives in Paris, then the outcome for our sale and VAT is very different. You sell to Pierre Inc., a VAT registered business in France, then that will be a zero rated sale, just as if we'd sold to anybody outside the EU. But if you sell to Pierre, an individual resident within the EU, then we must charge standard rate if it would have been a standard rated supply, but we'll have to charge the relevant rate of VAT. Usually here we'd anticipate 20% VAT to be charged to that customer. Okay, so we should now be able to deal with sales made by a UK VAT registered business to any customers, whatever they are, whoever they are, wherever they are, and know what the VAT system is. It's basically very simple. Most of your sales to overseas customers will be zero rated, except those that are to individual, i.e. non-VAT registered entities within the EU, like Pierre, our individual living in France, where it will be standard rated. It's slightly more awkward when we deal with imports. Now this is where it gets a little bit more awkward and where we'll need to have our thinking caps on. Right, let's look first of all where we buy goods in from a non-EU business. So we've got an American supplier, a Malaysian supplier, an Indian supplier, an Australian supplier, whatever, and we buy in goods from those particular businesses in those countries. Right, the importation of goods involves UK VAT being paid directly to HMRC at the point of entry into the UK. Right, so if we buy in goods from our overseas supplier from outside the EU, at the point of entry, usually at the port of entry of course there, but at the point of entry into the UK, we are going to have to pay what would have been the VAT on the purchase of those goods had they been provided to us, sold to us by a UK supplier. Clearly coming in from a business outside of the EU, there is no VAT being charged on that sale to us. If we'd bought £100,000 worth of goods from a UK business, we'd bought those in, and that sale to us was standard rated, we would have paid £120,000, the sales price for the trader, plus 20% VAT. We'd have paid £120,000 to the UK supplier. But if now we're buying them in from a Chinese business there is no VAT. And let's presume, therefore, that other than tax, the prices are the same. We would therefore be buying in for £100,000. Therefore, what we now have to do is, having paid £100,000 to the supplier in China, rather than £120,000 to the supplier in the UK, that supplier in the UK would then have had to have accounted for the output VAT on the sale to us, the 20,000 VAT. Now, there's no one. The Chinese company is not going to account for output VAT on the sale to us. They're Chinese there. So in which case, we have to make the payment of VAT due in relation to that purchase, that acquisition from the country, from the business registered outside the EU. So when we receive those goods to the value of 100,000, we'll have to pay to HMRC at that point of entry £20,000 VAT. So basically, whether we bought from the UK supplier or the Chinese supplier, our outlay of payments are the same. We'd have either paid directly 120,000 to the UK supplier, and the supplier would then have paid over 20,000 of that as VAT to HMRC, or we pay 100,000 to the Chinese supplier and then pay ourselves. We ourselves pay £20,000 of VAT to HMRC. So it's basically the same situation there, except how HMRC have gained the output VAT is us paying them directly rather than the person who sold the goods to us paying over the VAT on the sale. Okay, so when we buy in those goods from businesses outside the EU, we have to pay the VAT on that sale to us. Now then, had we been buying in those goods from the UK supplier, then we'd have paid 120,000 and we would have recorded the £20,000 VAT as input VAT. We do exactly the same now. We've paid out the tax, the output VAT as it were, we paid out the VAT in relation to the sale to us, and we now record that. We treat it as normal input VAT. Now what that should mean in the normal course of events is that we pay at the point of entry the VAT on the purchase we've made from the Chinese business. We pay over 20,000 to HMRC. We then record that 20,000 as input VAT, and on that basis therefore can reclaim the input VAT against our output VAT, reducing therefore the amount of VAT that we'll pay within the VAT return period. Regular importers can defer the payment of VAT under the duty deferment scheme if the UK business provides HMRC with a bank guarantee. The VAT on the import is accounted for on a monthly basis. So rather than having to account for and pay on every single individual purchase made from overseas at the point of entry, we can total it all up on a monthly basis and pay over that total figure. It just makes the management, the payment, therefore easier in terms of our transactions with HMRC. Let's do one transfer, one transaction, rather than potentially several such transfers. Okay, so in relation therefore to buying in from businesses outside the EU, we have to account for the VAT on the sale to us. We pay that to HMRC and then record that, assuming that we can recover the input VAT as input VAT. What about when we trade with other EU countries? Now again, we're going to be buying in, we presume here, from another UK VAT registered business. Now we already know that if we were selling to a VAT registered business within the EU, that the supply, as it says there, will be zero rated. So now when a German company, a French company, an Italian company sells to our UK registered business, then that sale to us is going to be zero rated. So when therefore our VAT registered EU supplier makes a zero rated sale, then the UK VAT registered business will self-supply. It's sometimes referred to as the reverse charge system. Pardon me, the reverse charge system in relation to the VAT, and we put it on our VAT return. Now, when we bought from the Chinese company, from the Australian company, from the American company outside the EU, when we bought those goods in, we paid to HMRC the VAT on the sale to us. What we do not now have to do is to make that payment at the point of entry. Instead, on the VAT return for the VAT return period in which that, we call it import, but its acquisition occurs there, we will record the amount of VAT on our VAT return in relation to that purchase as output VAT. So we don't actually have to pay HMRC, we can just put it in as a bookkeeping entry. It will go in as output VAT. Self-supply effectively means the UK VAT registered business will calculate the UK VAT due on the acquisition and declare it as output VAT on the VAT return. But of course, just like with when we bought goods from the American company or Chinese company, the VAT on that purchase can then be reclaimed as input VAT. So that is the VAT conters out. There's no VAT cost. So we've got, going through the same VAT return, the output tax recorded in relation to the purchase, and also then record that figure as input tax because it is on a purchase. So we don't actually have to pay over the money to HMRC as we did with the import from the Chinese company. Instead, we just record it as output tax on the VAT return, and assuming that we're able to recover that VAT as input VAT on our purchase, then we record it as input VAT. So instead of us paying them 20,000 and them repaying to us the 20,000, we just record it as output VAT, input VAT. One cancels out the other. We won't actually have to make any payments at all. Well, I say we won't have to make any payments at all. And it may seem that all of this is a waste of time. Why bother on the purchase from the Chinese company to pay HMRC the 20,000 and then recover it as input VAT on the VAT return? Why, when we buy in from the German company, do we record in relation to the same transaction both output VAT and input VAT of the same figure, £20,000? This seems to be a waste of time because we're not paying anything. Outputs equals inputs. Well, the only time where there will be a VAT cost is if the UK business makes exempt supplies. So then, as the exempt part of the business cannot reclaim input VAT. Remember back in, a long time ago now, but our very first lecture on VAT, we looked at the difference in terms of if a business makes taxable supplies as compared to if it makes exempt supplies. If a company or a business makes exempt supplies, there's no output tax to account for on the sale, but you cannot recover the input VAT on the purchase. So here's the reason why they go to the trouble of making us account for the output VAT on the purchase from the overseas business, either at the point of entry if we buy in from the Chinese company, or on our VAT return as output VAT if we buy in from the German company. Because if we then go on to use whatever we have bought in making what is for us within the UK an exempt supply for VAT purposes, it means that then we cannot record on our VAT return input VAT of £20,000. We will not get that £20,000 back as input VAT on our VAT return. So we will have ended up paying out the extra £20,000. Now that is as it should be. Now you might be thinking, doesn't sound fair. Well, actually it is. You think, if my business makes exempt supplies, then I cannot recover input tax on my purchases. So if I buy this £100,000 worth of goods from a VAT registered supplier within the UK, then I pay £120,000, the 100,000 plus VAT on the sale to me. I pay £120,000. I've suffered input VAT of 20. But what do I then do with that commodity? I then sell on and make an exempt supply. That means I cannot recover the input tax. So my cost of that purchase is the full £120,000. I do not get back the input VAT. If we didn't have this system that we've just explained on buying in from outside the EU, buying in from within the EU, if we didn't have the system that we do, think what would happen. I could buy in from the Chinese company or from the German company at what would be a VAT exclusive price of £100,000. If I didn't then have to account for the 20,000 VAT on that purchase, if I didn't have to do that, then I would not pay out 120. I wouldn't suffer any such VAT cost on that purchase. My net cost would be £100,000. So if I got a choice between, on the same purchase, paying £120,000 to the UK supplier or £100,000 to the Chinese supplier or the German supplier, what am I going to do? Very obviously, I'd be buying in from overseas. Now, no tax system is going to encourage us to buy from outside of your own domestic regime, your own domestic country. This would be silly if we didn't have this system that you either have to pay at the point of entry or include as output VAT on your VAT return, the VAT on the purchase you've made. If you didn't do that, we'd all be buying from overseas businesses rather than UK businesses in order to save that £20,000. Now, I hope you've understood the reason why the system works, given the reasons that I've just explained, but bottom line, guys, you simply have to learn. Remember what those rules are. Finally, here's a lovely word, finally. The supply of services. Now it's a lot easier that if you are selling to a business customer, doesn't matter there where that business customer is, it's overseas, then any such sale, provision of service to the overseas business customer, is outside the scope of VAT. If it's to an overseas non-business customer, basically an individual, then it must be a standard rated sale. If we're buying in a service from an overseas business, then this self-supply reverse charge system, as we explained up here, now also applies. So on the invoice to us from the overseas business, there is no VAT, but we have to account for that output VAT on that purchase and then record it as input VAT, which we'll be able to record and recover so long as we make taxable supplies. I said finally, well, there's one further example there for you to have a go at, and I'd like you, please, to do that now and then to review through the answer to that. Again, the answer should be, again, self-descriptive in terms of why we are doing what we are doing. Okay, that brings to an end, therefore, our study of VAT. It means that at this point, if we've gone through these lectures in the order in which I've suggested, the only things outstanding, a little bit of admin in terms of the tax systems for individuals and companies, that we have, of course, already covered in relation to corporate tax admin, the quarterly instalment payment system, back when we were looking at corporation tax, and I'd advise that you go back and revise that area before going to our next lectures on those admin chapters.